Okay, I want to spend a little bit of time, chapter 12 here, talking about what I consider probably the most useful investment tool for an individual investor. Mutual funds are analyzed, quite frankly, very similarly to stocks are. They have the similar types of risk measures. They have similar types of income measures. So there's many things we can do with mutual funds that allow the analysis to be very similar to some of the things we've talked about before. But it also provides us with a lot of benefits, if you will. So a mutual fund is called an investment company. Essentially, it's a corporation that purchases securities, and then people purchase part of this corporation. The first one was created in 1924. By 1940, they were starting to grow. By 2011, there was 8,600 of them. So there's probably by now tens of thousands of mutual funds. Most of them in existence today, obviously, invest in a whole variety of stock strategies that we'll talk about a little bit later. But I think it's important to note that more than 45% of all U.S. households own a mutual fund. And I find that number is probably a little bit on the low side, because I have to think that, a majority of Americans have some form of a retirement account. Even if they don't put much money into it, a lot of Americans have a retirement account, and most of those, if not 90% of those, all invest in mutual funds. So what is the attraction? Well, there's four things you really get when you buy a mutual fund. And the first thing is the most important thing: portfolio diversification. They're going to invest in many, many things. So the risk, the diversifiable risk that we talked about in a previous chapter, is taken care of by this company. They eliminate that risk that is very easy to eliminate by adding more securities. The way they can do that is because they are professional managers. We're going to pay them to make the decisions for us. And this is where I think is one of the better aspects of a mutual fund, is that a person pays for somebody that knows how to invest. So I don't have to spend hours and hours of time of researching 10, 20, 30 companies to figure out which ones I want to invest in, where a mutual fund can look at hundreds and hundreds of companies and determine which are the best of those hundreds. You're going to be able to invest in relatively small amounts. Some mutual funds, for as little as $25 or $50, you can invest in that mutual fund. So you don't need thousands of dollars to invest in these things. And you get great services. They will automatically reinvest dividends and capital gains. You can create withdrawal plans, so they'll send you payments from your investment portfolio. You can switch within the home. That's what this exchange privilege is all about. So there are great services that you get when you invest in a mutual fund. And quite frankly, it's just convenient. They're easy to buy and sell. They're highly liquid. The mutual fund company handles all the record keeping, very easy to track prices. So mutual funds are just a very special tool that the individual investor can use to get to where they need to be on an investment side. What are some of the drawbacks? Well, there are some. The book refers to these as substantial transaction costs, but quite frankly, they're not necessarily substantially different than what you would get if you bought stocks or bonds. You have to pay a management fee. Well, guess what? If you have an account at Schwab or any of the other companies that you can think of that where you would have an account, guess what? You're going to have to pay some form you have to pay some form of a fee for them to handle your account. So there's always going to be a management fee when you have an account. They say that the commission fees on load funds are high. Well, they're really not. If you buy a stock, you're going to pay between 1, 2, 3% when you purchase a share of stock. But when you sell that stock, you're also going to have to pay that same percentage out. For a mutual fund in general, you pay a load now, you pay a fee up front, but you don't typically pay one when you leave. So it might be a little higher in the beginning, but if this is a good investment and it makes money and it grows your wealth, you don't want to have to pay a percentage that's even a greater dollar amount later. They also mentioned that they have lower than market performance. They said consistently beating the market is difficult. And again, I just don't believe that the data really shows this. Many mutual funds that say just keep even with the stock market index. And I have to tell you, it's a misleading statement when they say that. What they're going to do is they average all mutual funds together. So they're going to average mutual funds that invest in treasury bills. They're going to average that with mutual funds that invest in stocks and bonds and maybe gold futures or gold gold companies, right? So they're going to have this whole wide range, and they average them all together and compare them to the stock market. When you think about it, you're really averaging the whole world together, and they're calling that the stock market, and you're going to get a number that's very close to the stock market index. You can find mutual funds that beat the stock market on an annual basis almost every single year. You can go back and find mutual funds that have averaged 10, 11% for the last 80 years. So it's possible to find them. Okay, that's where the analysis part comes in blue. So those two statements, even though they are partially true, I believe in the end they are not totally true. There is room for us to make money by investing in mutual funds. The general performance here, what they talk about, comparative performance versus market benchmarks. I mean, it's a very loaded question. It's a very loaded question. So again, here we say that in general, how have they done compared to the rest of the world? The domestic equity market has about 33% of the world's performance, right? 25% is the bond market. World equity market, right, is this 12%. So this shows relatively the kinds of returns that are earned, or the relative of all the performance that can be earned, where you can find that type of earnings, where you can get that kind of money. So how are they organized? A management company runs the funds. There's somebody called an investment advisor. They buy and sell stocks, etc. There is a distributor that's going to sell these mutual funds. They can do that directly to the public, or they could do that through brokerage firms. So there's going to be a distributor. It's either direct to the public, in other words, it's the mutual fund that's selling to the public, or there could be brokerage firms that help sell mutual funds for some of these companies. So if you think about Fidelity, for instance, Fidelity basically offers their mutual funds through brokerage firms. Now, can you buy them directly through Fidelity? You can if you have an account there. You can buy them, but essentially you're buying them through their broker-dealer. There's a custodian that keeps track of the securities. There's a transfer agent that keeps track of all the purchases and the requests of shareholders. So there are essentially four companies, or four individuals, if you will, that work and manage the things that go on in a mutual fund. Frequently, the custodian transfer agent act as one person, or they are one single person. So there are several different kinds of mutual funds. The first one is something called an open-end investment company. And that's what we talk about most when we talk about mutual funds. Investors buy and sell their shares directly with a mutual fund company or brokerage firm, and there's no secondary market. So the transaction occurs only between the investor and the mutual fund company. So the mutual fund company can issue an unlimited number of shares. Now, it really doesn't grow into the, excuse me, the unlimited numbers, because people will redeem their shares. So every time you redeem or sell a share back to a mutual fund company, those shares, or the numbers of those shares, are technically destroyed. Every time you buy a mutual fund from a company, you're buying a brand new mutual fund. It's never been owned by anybody before. The NAV, right, is what's referred to as the value of the portfolio. You take the value of all the securities in the mutual fund portfolio and you divide it by the number of shares outstanding. So the NAV essentially is the share price of a mutual fund. Now, what price you pay depends on how you're buying them. If you're buying them directly, maybe from the mutual fund company, maybe there's no commission, or the commission is very low, so that the NAV will be very close to the market price. But if you buy this through a broker and there is a load or a fee, a commission, then obviously the commission is incorporated into the market price. So all purchase and sales are completed at the end of the day after the stock markets have closed. So if you think about during the middle of the day, we can't do a calculation every second of the day for every number of shares that are in every mutual fund. It would be unreasonably difficult to do that. So what mutual funds do, if you call at 9 o'clock in the morning and say, hey, I wanna buy $500 worth of this mutual fund, at the end of the day, they figure out what the share price is. They divide that into 500, and that's how many shares you buy at the end of the day. The next day, if you want to sell $700 of a mutual fund, at the end of that day, they figure out the market price, they divide that into $700, and that's the number of shares that would be redeemed from your portfolio. Closed-end investment companies act more like selling stocks from a corporation. There's only a set number of shares in the fund. They're offered at the very beginning. So any trades that we do on these closed-end investment companies are actually done in the secondary market. Again, very similar to common stock. They have limited numbers of shares. Investment advisors don't actually have to worry too much about cash inflows and outflows here, because they don't have to worry about money coming into the fund or out of the fund. The fund is created, and when all shares are redeemed, then the mutual fund closes. Now, the challenge that we have here is that the price of these funds is determined by supply and demand, in addition to the value of the funds, of the assets within the fund. So the actual price could be different from the net asset value. It could sell at a premium or a discount. Now, normally it's going to sell at a discount, but it could be selling at more than what the NAV value is. So we have to be cognizant that there's a different analysis piece that goes into looking at these closed-end funds, is that we have to look at the supply and demand of the fund itself. There are things referred to as exchange-traded funds, ETFs. These are very popular right now. Essentially what they are is it's a mutual fund that's geared to follow or track a specific index. So if you want to buy a investment, you want to have an investment portfolio that very closely tracks the S&P 500. As you see down below, you would buy a SPDR. So SPY is the ticker symbol. That would follow the S&P 500. It trades just like individual stocks on stock exchange. You can buy and sell them any time of the day because it's more like a stock. They have low management expenses because there's very little trading done by the investment advisor. These are almost unmanaged funds. They buy something that looks like the S&P 500 and they hold that. And one of the advantages to that is, since there's very little buying and selling, there are also very little taxes that ultimately have to be paid through capital gains, etc., as the years pass and you hold these investments. So those are three different types, if you will, of mutual funds that you can purchase. The next thing we need to talk about are expenses. What happens when you buy a mutual fund? What is the cost of doing that? A load fund is a load. A load is essentially a commission. So there is a commission that's charged when you buy, essentially through a broker. What is that fund? I mean, a load fund are typically 2 to 3%. You'll rarely see loads that are in excess of 5.5 or 5.75%. You rarely see anything higher than that. A no-load fund is when a mutual fund is sold directly by the mutual fund. Essentially what we're doing is, since they're cutting out this middle person here, they're saving a little bit of money so that, they're saying they're giving investors a head start in getting some superior returns. The distinction between how these things ultimately are, when you incorporate all the expenses, they're actually pretty close. There's really not that much of a distinction in the returns of a load versus a no load when you incorporate all the expenses of owning an investment. A back-end load is when you would pay a commission if you sell the mutual fund. Very few of these pure backload funds exist. Mostly everything is what's referred to as a front-end load, right? You pay when you buy, you don't pay when you sell. There are some expenses, right? There's something referred to as a 12B1 fee. Now, almost every mutual fund charges this. It helps to cover some management fees, cover some other operating costs. It could be as much as 1% of the average net assets of the company. So it's a fee that everybody pays when they buy a mutual fund, and you pay it per year. There are also management fees. Now, these management fees are usually fairly low. They're certainly most likely going to be less than 1%. It's compensation that pays the mutual fund for managing your money, right? It's paid by all funds, load, no load, open-end, close-end. They're all the same. So you could buy a load mutual fund and you could buy the identical no-load version. They both have a management fee. You have to pay people to manage your money. There's some administrating costs, right? The company has to buy and sell things, so they have to have trading expenses. All of these expenses are paid by all the mutual funds. So this is just them transferring the cost of trading off to the investor. Well, if you were doing this on your own, guess what? You would have to pay some of these fees yourself. Now, how do you pay taxes on mutual funds? Right? Mutual funds themselves do not pay taxes as long as they pass income and capital gains off to shareholders. So shareholders are going to be taxed on the distributions that they receive. The distributions they receive is the income that's earned by the securities and the capital gains that are earned through the trading of those securities within the fund. So what do these fees look like? What does a table look like? Well, you look here, it says, here's a maximum sales charge on this mutual fund is 3%. There's no load on reinvested dividends. That they don't charge for those things. There's no deferred sales charge, so you don't have to pay that later. There are no exchange fees, right? There's an annual account maintenance on this of $12. So it's $1 a month to have this if you have an account under $2,500. It's $12. What's the management fee? 0.45% is the management fee. Other expenses, 0.2%. So the total annual operating expenses, the expenses of managing your money, is less than 1%. You will rarely see this number be more than 2%. So it's a very low percentage that's paid annually to have one of these mutual funds. So again, that's a very basic look. We got more things to talk about with mutual funds. We'll continue that as we go on.